You know that moment when a tax case turns on one deceptive simple question? Is this real business or is it just a very expensive lifestyle? Because that's exactly what happened here. The numbers start small, then ramp up fast. The parties agreed on about $146,000 of offsetting ranch expenses for 2016, but the taxpayer kept pushing for around $352,000 total by adding roughly $206,000 more on top. And when the dust settled, the tax court said, yes, it all stays in. About $352,000 allowed, and nothing knocked out under the hobby loss rule at issue. That's not a paperwork victory. That's a story about whether the court believed this ranch was being rebuilt to make money or whether it was just burning cash with a cowboy hat on. I'm Alex Dvorkin, CPA, certified public accountant in the state of California, and if you like this kind of case breakdown, please like this video and subscribe to this channel, because this channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law really works. In this video, we cover the tax court decision in the case of Kenward Kolar Jr. Petitioner versus Commissioner of Internal Revenue, decided on February 9, 2026. Now, before we even get to the ranch, the court sets the stage with what's already on the table. The notice of deficiency. The IRS determined a 2016 deficiency of about $292,000 and additions to tax that the taxpayer ultimately considered. The taxpayer also considered a major income adjustment, unreported gross income of nearly $829,000, and the parties agreed that there were offsetting expenses totaling about $146,000 for 2016. So by the time the case reaches the court for decision, the battlefield narrows to one remaining fight: whether the activity not engaged in for profit rule, section 183, would limit deductions an additional roughly $206,000 of farm expenses for 2016. And the court tells you the court tension in plain language. Substantiation wasn't the problem, and even attribution to the ranch wasn't the problem. The disagreement was only whether the taxpayer engaged in ranching activity for profit in 2016. That sentence matters because a lot of these cases turn into a slog of receipts and missing logs. This one turns into something more human. Do we believe this person was rebuilding a working ranch as a profit-seeking operation, even if it was losing money in the short term? The backstory reads like a family saga, written across land and time. The ranch had been in the family since late 1800s, and it wasn't one neat rectangular on a map. It was multiple non-contiguous tracts of land in south central Texas, totaling approximately 836 acres. Over generations, the ventures rotated in and out: dairy cattle, beef cattle, poultry and eggs, catfish and tanks, hay production, and pecan orchard. The daily operation in particular wasn't a casual sideline. The opinion describes how it took several years to develop the dairy cows, and eventually the family was milking approximately 600 cows twice a day until increased competition and regulatory burdens pushed the dairy operation to the end sometime in 1990s. Then the personal turning point arrived, one after another. The taxpayer had lived on or near the ranch for most of his life, studied animal science and biology for his bachelor degree, and later earned a master's degree in water supply and wastewater disposal. But the management transition wasn't a clean handoff. The operation describes the father's chronic illness with cancer, ending with the father's death in 2010. After that, the taxpayer became owner of the land, while the mother inherited the financial assets and managed operation until she so became ill. By 2016, she was totally blind and mentally disabled. And at that point, the taxpayer took over management of the ranch. She died in 2017, and then he took full ownership of the ranch enterprises and financial assets. So when we talk about 2016, we're not talking about a stable year where everything is humming. We're talking about the year the court describes as a takeover during decline, a point when the ranch had fallen into despair. The opinion lists what that meant on the ground: restoring fences, replacing old equipment, clearing overgrown pastures, and rebuilding the livestock herd, starting with beef cattle. And then there is the detail that feels like a villain in a western: a small, thorny, bush-like tree that made vast tracts unusable, and the taxpayer had to clear it out. Here's where the profit motive fight becomes real. The opinion recognizes the basic reality. Even if you do everything right, building a profitable beef operation from breeding stock takes time. The court says that breeding a sustainable and profitable beef cattle herd can take many years, and that when the taxpayer began managing the ranch, he anticipated profitability would take 5 to 6 years. This becomes one of the central narrative beats. The taxpayer wasn't claiming instant riches. He was describing a startup period where the work comes first and the money comes later. The court also paints a picture of effort that doesn't look like weekend recreation. It says he worked long hours every day of the week. He didn't have time for cattle shows or similar ranching-related recreational activities, even though he had done rodeos when he was younger. And the plan he described wasn't a vague dream. He wanted to increase the herd to around 250 head of cattle, and he believed it could grow further if his young son eventually took over. The court also notes the sentimental attachment and the desire for the ranch to stay in the family, but it doesn't treat that as disqualifying. More on that later. On the operations side, the spouse shows up, in the opinion, as the person handling the money trail. The court describes a separate checking account for ranch operations, apart from household expenses, and then an almost obsessive multi-step records-keeping process: a check register, a category book for daily items, a weekly book for review with taxpayer, and then a monthly Excel spreadsheet and a final year-end spreadsheet. The IRS tried to make hay out of what wasn't in evidence, arguing that the absence of formal financial statements in the record would count against the taxpayer. But the court basically responds, "Nice try." It points out that IRS counsel reviewed at least 2 ranch ledgers during a court-ordered recess. The parties then made mutual concessions and stipulated too many expenses. And the spouse testified credibility about the records keeping and identified the ledgers under oath. Given those stipulations and concessions, the court says it doesn't fault the taxpayer for not putting all the underlying records into the trial record. The ranch also wasn't living on cattle alone. The opinion emphasizes that a significant non-agricultural revenue stream came from rents and royalties paid by oil and gas companies extracting from the property. And it notes that from 2017 through 2022, the taxpayer reported a total royalty income of about $2,350,000. The ranch also sold water from artesian wells to oil companies and the neighboring pecan operations, generating income that ranged from $500 to $40,000 in 2016 and 2017. And yes, those are small numbers next to 7-figure of royalties, and the opinion treats them that way. Supportive, but not headliners. Then the world punches the operation in the face repeatedly. The opinion describes Hurricane Harvey in 2017 destroying many, but not all, of the books and records. It describes the COVID-19 pandemic impact in 2020, including the 5 ranch employees died from COVID-19. And it describes a severe winter storm in February 2021, electricity gone for 2.5 weeks, wells frozen and burst pipes. Many cows dying from thirst. The opinion adds more adversity: fire, droughts, grasshoppers, and flood, while nothing the ranch still continued raising and selling cattle in limited numbers, including a sale of 15 heads of cattle in 2021. Okay, so what does that have to do with Section 183. This is the part where the law becomes story. Section 183 is the rule that can limit deduction if activity is carried on primarily as a sport, hobby, or recreation. The court says it has to decide whether in 2016 the taxpayer continued the activity with an actual and honest objective of making a profit, what the opinion calls a bona fide profit objective. And importantly, the court stresses that no one factor is determinative, and it's not just a scoreboard where you count up factors like a baseball game. But before even applying the factors, the court has to define what the activity is. The IRS wanted to narrow definition the cattle ranch activity. The taxpayer wanted something broader, including land appreciation and oil and gas exploration, arguing that improvements like road and fences serve both. The court lands in the middle, but not in taxpayers' favor on the framing. It concludes the relevant activity is ranching activity generally, but it doesn't include land appreciation or oil and gas exploration, and it treats royalties as a separate activity because oil and gas extraction is a fundamentally different enterprise. However, the court agrees the ranching activity includes developing well water because it supports the cattle herd. Then comes the heart of the opinion, the 9 factors. In a lot of cases, this section reads like a sterile checklist. Here it reads like the court deciding whether it believes the rebuild narrative. On the business-like operation, the court says straight up that the taxpayer operated the ranch in a business-like manner, highlighting the separate bank account and the spouse's structured bookkeeping system. It also addresses the lack of a written business plan, but concludes he clearly had a plan to increase the herd over time through buying and breeding, and the court treats that as sufficient, calling his testimony credible and the steps sufficient to constitute a business plan. On expertise, the court acknowledges decades of ranch experience plus the animal science and wastewater degrees. The IRS argued he knew how to care for cattle day to day but lacked economic expertise. The court rejected that, noting he testified credibly about prices and markets, showing expertise in marketing and sales too. On time and effort, the court emphasizes this was his full-time occupation for years, including 2017, and says he was not a cattle ranch dilettante, a fancy way of saying not a dabber pretending to be a rancher. On asset appreciation, the court takes a neutral view, because it already defined the activities ranching, not holding land for appreciation. On success in other ventures, it also goes neutral, because the record lacked evidence supporting claims of success in dissimilar activities. Now we hit the factors that make the IRS argument feel dangerous. On history of income and losses, the opinion admits the losses were troublingly large, relatively to gross receipts over the years, the IRS highlighted. But the court accepts the taxpayer's explanation as plausible, that this was a degraded range needing reinvestments, that growing the herd takes the stated 5 to 6 years, and that unforeseeable setbacks like bad weather and COVID-19 pandemic affected the path to profitability. So it says these factors weigh slightly against the profit motive, not heavily. On occasional profits, same thing, slightly against. On financial status, the court considered the IRS had real ammunition. The taxpayer had substantial royalty income from oil and gas, and those losses could produce tax benefits. Because the court treated royalties as a separate activity, it views this factor as weighing against profit motive for ranching. This is the part where IRS theme is basically, you can afford to lose money ranching because the minerals pay the bills. And then we come to personal pleasure, the classic, this is a hobby factor. The court's language here is vivid. The taxpayer's physical appearance and demeanor did not suggest a hobbyist who enjoyed recreational ranching. He expressed concern about needing to get back to tend the herd when scheduling trial days. The IRS tried to lean on the spouse's enjoyment of 2 horses, but the court says the horses were treated as pets, and it doesn't view that as relevant to analyzing the ranching activity. The IRS also argued the taxpayer bonded with his son through ranching, but the court notes that the son was 2 years old in 2016 and unlikely to have participated in any meaningful way. And then comes a line that, in my view, is the opinion's quiet moral center. The court says it doesn't view training children to farm and ranch, hoping they'll one day take over, as inconsistent with profitable motive, adding that family members often participate in profitable small businesses. The court actually treats that broader family business farming as supportive profit motive. At the end, the court tallies the factors. 4 favor the taxpayer, 2 are neutral, 3 weigh against. But it emphasizes that the decision is qualitative, not just arithmetic. And the court's bottom line is clear. The factors favoring profit motive outweigh those against the taxpayer, gave credible explanations for the long startup period and the long path to profitability. And even though the biggest negative factor was the taxpayer's substantial royalty income, it simply doesn't outweigh the other evidence. So the court concludes that for 2016, the Section 183 limitation does not apply to the ranching activities, meaning those additional expenses stay deductible. And that brings us right back to where we started. The difference between $146,000 and around $352,000 wasn't just math. It was credibility. It was whether the court believed the ranch was being rebuilt as a profit-seeking operation, even in a year where the ranch was still clawing out of despair, and even though the income existed elsewhere on the property. The tax court looked at the separate accounts, the structured records, the long hours, the stated herd growth plan, and the real-world setbacks, and it treated the operation as business, not a hobby. So here's the satirical takeaway, grounded in exactly what this opinion shows. If you want the court to believe you're running a business, you have to look like you're running a business, especially when you have enough outside income that the IRS can argue you're just buying deductions. In this case, the taxpayer didn't win because ranching is romantic. He won because the court believed the grind was real. I'm Alex Dvorkin, certified public accountant in the state of California. If you like this video and found this information useful, please like this video and subscribe to the channel. And I'll see you in the next tax court case review.